This chart shows the compounding return of the S&P 500 compared to Vanguard's Windsor Fund from 1964 to 1995. $1 invested in the broader market grew to $22. That same dollar, managed by John Neff, grew to $56. He achieved a 13.7% compound annual growth rate, beating the market by an average of 3.1% every single year for 3 decades. That margin of outperformance over 31 years eliminates the possibility of luck. Neff did not rely on high-risk speculation or macroeconomic forecasting. He built a rigidly engineered mathematical system designed specifically to exploit the emotional reactions of the broader market. To understand how that system was built, we have to look at the market environment where Neff started his career in 1955. Wall Street operated at an analog pace, tracking trades on physical ticker tape. The institutional memory of Wall Street was paralyzed by fear. The catastrophic crash of 1929 still cast a long shadow over money managers. It took the Dow Jones Industrial Average 26 years just to return to its pre-crash peak. Neff realized that this deeply embedded fear created massive pricing inefficiencies. His entire strategy was forged by fighting this conservative, herd-driven consensus, using pure, uncompromising quantitative logic. His contrarian framework rested on 3 core axioms, drawn directly from his early life. The first is the danger of momentum. Neff learned this at age 12, observing how his peers behaved during local speculative crazes. During a bubble in vintage baseball cards, he noticed that the cards pushed to the highest, most irrational prices by hype were always the ones to crash the hardest when the momentum broke. He carried that skepticism of overvalued assets for the rest of his career. The second axiom is the necessity of asymmetric bargains. This came from observing 2 vastly different family businesses. While one relative failed trying to run a high-end, premium-priced shop, another built a highly successful discount supermarket. Neff saw that real safety and profit came from acquiring high-utility assets at steep discounts, prioritizing reliable volume over prestige. The third axiom, institutional inefficiency, crystallized when Neff took a job as a securities analyst at National City Bank. He watched senior bank managers funnel capital into established, high-priced industrial juggernauts. They bought these stocks simply because they felt safe and popular, completely ignoring the underlying financial fundamentals. Guided by mentors like Sidney Robbins and Art Bonas, Neff combined these observations into a unified operating philosophy. To generate true alpha, an investor must fight the prevailing market consensus, but only when that stance is backed by an impenetrable mathematical thesis. In 1964, Vanguard handed Neff control of the Windsor Fund. It had been gutted by trend chasing, losing a quarter of its value in a single year. Neff immediately stripped away the speculation and instituted a ruthless 7-point quantitative checklist to isolate the market's bargain basement. Criterion 1 was the mandatory entry gate, a low price-to-earnings ratio. A stock had to be priced 40 to 60% below the broader market average. If it failed this threshold, it was immediately rejected. This massive discount served a dual mechanism. It established a hard floor that protected the fund during downturns, and it primed the investment for upside when the market eventually corrected the valuation back to the average, a process known as multiple expansion. Criterion 2 demanded fundamental growth, but restricted it to a very specific corridor, strictly between 7 and 20%. Neff explicitly avoided companies growing faster than 20%. He operated on a rule he called less 1 cent, lose $1. When a hyper-growth company misses inflated market expectations by a single penny, investors panic and the valuation multiple collapses. A low PE ratio on a company with no growth is a value trap. It is cheap for a reason. By demanding a steady, unglamorous 7 to 20% growth rate, Neff mathematically validated that the discount was an error by the market, not a dying business. Criterion 3 was yield protection. Neff targeted companies paying high, sustainable dividends. He viewed this cash flow as a free lunch that provided an automatic baseline return and buffered the portfolio during severe bear markets. This equation is Criterion 4, the total return ratio. It serves as the mathematical engine of the entire Windsor strategy. You calculate it by adding the company's earnings growth to its dividend yield and dividing that sum by its price-to-earnings ratio.
Neff demanded this ratio be exactly double the broader market average.
This single metric forced the algorithm to find the absolute maximum combination of yield and growth for the lowest possible price. Criterion 5 dictated strict rules for cyclical exposure. For heavy industries with fluctuating earnings, Neff bought 6 to 9 months before an anticipated recovery, when pessimism was highest, and he sold just before earnings hit their absolute peak. Criteria 6 and 7 refined the search to solid companies in growing fields. Neff hunted for second-place market players that boasted impeccable cash flow, specifically retained earnings plus depreciation, and a high return on equity. Running every stock through these 7 parameters completely eliminated human intuition from the buying process. Neff systematically engineered a portfolio with mathematically asymmetric risk and reward. Once a stock survived the filter, Neff applied a portfolio structure he called measured participation. Every holding was assigned to one of 4 rigid buckets: high-profile growth, low-profile growth, slow growth, and cyclicals. He completely rejected modern theories of broad diversification. At its peak, Windsor was an $11 billion fund, yet Neff concentrated that massive capital into roughly 60 stocks, with his top 10 holdings comprising 40% of the entire portfolio. Identifying cheap companies was only half the algorithm. Neff operated on a strict axiom: Windsor stocks are bought to be sold. He enforced 2 absolute triggers that mandated an immediate exit. A stock was sold the moment its underlying fundamentals degraded, or the moment its price reached the pre-calculated PE normalization target. He refused to chase momentum. If a stock hit fair value, Neff dropped it instantly, regardless of how fast it was rising or how much Wall Street favored it. Professional institutional outperformance relies just as heavily on this robotic, unemotional sell discipline as it does on finding the initial undervalued purchase. We can observe the power of this system in practice by looking at May 1991. The Windsor algorithm was built to operate best during moments of extreme market distress. A macroeconomic panic surrounded Citicorp. The bank was drowning in immediate frenzy over Latin American bad debt and massive domestic real estate write-offs. This chart shows the catastrophic impact on the bank's valuation. Investors priced in imminent bankruptcy, sending the stock plummeting violently from over $30 a share down to roughly $8. While the financial press attacked Citicorp's CEO and institutional capital fled, Neff's mathematical filter triggered massive buy orders, stepping directly in front of the retreating herd. Neff looked past the headlines. By stripping away the temporary, highly publicized bad debt, the numbers revealed a highly profitable, severely undervalued global consumer banking and credit card franchise hiding underneath. The underlying cash flow was strong enough to survive. Citicorp executed its restructuring plan, and its earnings rapidly rebounded. Because Neff bought at a deeply suppressed multiple, the normalization of the stock's PE ratio generated an explosive upward surge in 1992, locking in a massive gain for the Windsor Fund. The Citicorp crucible proves the function of the Windsor framework. It provides the mathematical conviction required to buy exactly when emotional panic blinds the broader market. Neff proved this contrarian exploitation was a highly repeatable process. He applied the exact same approach to the insurance giant Cigna that very same year. When the market panicked over Cigna's environmental liabilities, Neff's cash flow math proved the debt was entirely serviceable. He bought into the fear and walked away with a 54% gain. He also engineered structural advantages alongside his stock selection. By utilizing the capital shares of the Gemini Duo Fund, Neff achieved 2-to-1 upside leverage in deeply discounted environments without taking on traditional margin risk. His permanent hunting ground remained the 52-week low list. He continuously scoured the discount bin, searching for the ignored, unglamorous free gifts hidden inside established companies. John Neff's 31-year track record leaves behind a definitive legacy. Institutional alpha is not generated by predicting the future. It is generated by mathematically exploiting the market's psychological overreactions through an unwavering, emotionless commitment